Ever wonder if your investment strategy could use a little shakeup? Well, you're not alone. One of the key ways to ensure your financial health is through diversification. But what exactly does that mean? Picture a basket of fruit. If you only have apples, and apples suddenly become less popular, you're in trouble. But if you have apples, oranges, and bananas, you're better protected against shifts in demand. That's diversification in a nutshell. Now apply that logic to your investments. If all your money is tied up in one type of investment, and that sector takes a hit, your financial security could be at risk. Diversification helps mitigate this risk by spreading your investments across various sectors and asset classes. It's like having financial shock absorbers that soften the blows of market volatility. So how can you start diversifying your portfolio? Let's find out. First things first, diversifying isn't about randomly throwing money at different investments. It's a calculated strategy that requires understanding and thoughtfulness. Diversification, at its core, is about spreading your investments across a variety of assets to reduce the risk of any single investment dramatically underperforming, thereby causing a significant loss. It's like the old saying goes, don't put all your eggs in one basket. The first step in diversification is identifying suitable investment options. This process involves conducting research and analysis to understand the potential returns and risks associated with various types of investments. You might consider stocks, bonds, real estate, or even cryptocurrencies. Each of these assets has its own potential for return and risk, and it's essential to understand these before making a decision. However, it's not enough to simply pick a variety of investments. The key to effective diversification is choosing investments that are not directly correlated. This means that when one investment is performing poorly, another may be doing well, balancing out the overall performance of your portfolio. Now let's talk about aligning your investments with your personal financial goals. This is an often overlooked but vital aspect of diversification. Whether you're saving for a down payment on a house, your retirement, or your child's education, your financial goals should guide your investment decisions. For instance, if you're nearing retirement, you might prefer safer, income-producing assets like bonds, while a younger investor might take on more risk with stocks or cryptocurrencies. Remember, diversification is not a one-size-fits-all strategy. It's a personalized approach based on your individual financial goals, risk tolerance, and investment timeline. Regularly reviewing and adjusting your portfolio is also part of this strategy, as market conditions and your personal circumstances can change over time. Now that you know the basics, let's dive into some specific investment areas. Scene script. Stocks are a familiar investment vehicle for many, but are you using them to their full potential? When we talk about diversifying a portfolio, stocks often come to mind first. They offer the opportunity for substantial growth, especially over the long term. However, they also come with their fair share of risks, and understanding these is crucial to successful investing. So, how do you harness the power of stocks for diversification? Let's unravel this mystery. In the investment world, stocks represent shares of ownership in a company. When you buy a stock, you're essentially buying a piece of that company. The value of your stock goes up and down with the company's performance, and this is where the potential for growth comes in. But here's the kicker. Not all stocks are created equal. They come in different shapes and sizes, from large multinational corporations to small, innovative startups. They span across various sectors, from technology to healthcare, finance, and more. This variation is what makes stocks a fantastic tool for diversification. By investing in a mix of different stocks, you can spread your risk across multiple industries and company sizes. This way, if one sector or company takes a hit, your entire portfolio won't go down with it. Sounds great, right? But how do you choose which stocks to invest in? A good rule of thumb is to look at the company's financial health, its competitive position, and its future growth prospects. There's no one-size-fits-all answer here, and it's important to do your research before making any decisions. But remember, investing in stocks can be risky. The market can be unpredictable, and there's always the potential for loss. That's why it's essential to consider your risk tolerance and investment goals before diving in. Stocks can be a powerful tool in your diversification strategy, but they're not the only one. Just like a well-balanced diet needs more than just one food group, a well-diversified portfolio needs more than just stocks. So stay tuned as we explore other investment vehicles in the next scenes. Beyond stocks, bonds, real estate, and even crypto can add layers to your investment strategy. Let's delve into each of these, shall we? Bonds, for starters, are essentially IOUs issued by governments or corporations. When you purchase a bond, you're lending money to the issuer, who promises to pay you back with interest. The beauty of bonds lies in their stability. They can be a safe harbor when the stock market is choppy, providing a steady stream of income. However, they're not without risks. Inflation can erode their value over time, and there's always the chance the issuer might default. But as part of a diversified portfolio, bonds can cushion against the volatility of riskier assets. Next, we have real estate. Owning property isn't just about having a place to live. It can also be a powerful wealth-building tool. Real estate has the potential for both income and appreciation. You can earn rental income and benefit from the property's increase in value over time, plus it's a tangible asset, something you can see and touch. But remember, property values can fluctuate, and managing real estate can be time-consuming and costly. It's not a game for the faint-hearted, but if played right, it can be a pillar of your investment strategy. Finally, let's talk about the new kid on the block, cryptocurrency. Crypto is a digital or virtual currency that uses cryptography for security, and it's been making waves in the financial world. The most renowned, Bitcoin, has seen astronomical gains since its inception. But it's not just about Bitcoin. There are thousands of cryptocurrencies out there, each with its own potential. Investing in crypto can offer high returns, but it comes with high risk. The crypto market is notoriously volatile, and there's the ever-present risk of loss due to hacks or scams. But with careful research and risk management, crypto can be an exciting addition to a diversified portfolio. Now, it's important to remember that diversification isn't about tossing your money randomly across different investments. It's about carefully selecting a mix of assets that align with your financial goals and risk tolerance. Bonds can provide stability, real estate can offer tangible wealth, and crypto can deliver potential high returns. Each has its place in the grand scheme of your investment strategy. By spreading your investments across these areas, you can create a robust and diversified portfolio. Remember, the goal is not to achieve overnight riches, but to build wealth over time, riding out the inevitable ups and downs of the market. The path to financial success is a marathon, not a sprint. And with a diversified portfolio combining stocks, bonds, real estate, and crypto, you're well equipped for the journey ahead. So, we've covered a lot today, but what should you take away from all this? Well, let's briefly summarize the key points from our discussion. Firstly, we delved into the importance of diversification. Remember, putting all your eggs in one basket is risky. Diversification helps you reduce risk while still allowing for potential growth. It's like having a safety net while you're walking a financial tightrope. We then explored the basics of diversifying your portfolio. It's not about randomly picking different investments, it's about careful selection, considering your risk tolerance, financial situation, and goals. It's about finding the right mix that aligns with your unique circumstances. Next, we talked about diversifying with stocks. A mix of different sectors, industries, and company sizes can help you weather market fluctuations. Remember the saying, don't judge each day by the harvest you reap, but by the seeds you plant. Investing in stocks is all about planting those seeds for future growth. Then we moved on to diversifying with bonds, real estate, and crypto. Bonds can provide steady income and are generally less volatile than stocks. Real estate, on the other hand, can offer a tangible asset that can appreciate over time. And crypto? Well, it's the new kid on the block, with its own set of risks and rewards. It's volatile, yes, but also potentially lucrative. Just remember, with greater reward can come greater risk. So, what's the bottom line? Diversification is not just about spreading your investments. It's about strategic allocation based on your financial goals, risk tolerance, and investment horizon. It's about creating a robust portfolio that can perform in a variety of market conditions. Remember, diversification is about balance and aligning with your financial goals. So, ready to shake up your investment strategy? It's time to take action, to make informed decisions that can help you build a stronger, more diversified portfolio. So let's get started.